Sure. So for those of you who actually might be completely new to Lawpath, just to give you a quick introduction, a few accolades I'm going to throw out there, and why we're, passionate about this topic and why at all we're even an authority to speak on it. So Lawpath, we fundamentally exist to make legal simple, accessible for small businesses across Australia. As you can see on the screen there, we've helped over 500,000 businesses navigate the legal side of running a company, helping you from creating documents, managing your compliance, connecting with lawyers, the accountants on demand. It's all here, it's all on one platform. We are that one-stop shop. You can't see on here, but we're actually on track to assist 1 million businesses by 2030. And very relevant to today's topic, we're actually Australia's largest incorporated now businesses, more than ASIC, more than the government website. So that's either through 2/3 of accountants in Australia actually use us, or mostly from people just like yourself who semi self-register the business through us. But I'll speak more to what that means at the end. And we're very proud we've actually saved over $500 million in legal fees in our 10-year. We're backed and partnered by Westpac. We've got over 10,000 credible 5-star reviews on platforms like Bazaar Voice. So simply put, our mission is to empower you to make informed, confident decisions without any of the complexity or hefty price tag that usually comes with legal advice. But don't just hear it from me. I'll see if I can put it in the chat now. Feel free to go and check out our client testimonials. They are 3 to 6 minute videos from businesses by industry, maybe very similar to yours. So do feel free to have a look there. So that brings me to today's presenter. So I want to introduce who's joining us today, Mashrur Shan. He's a commercial lawyer here at Lawpath, the MITI solicitor here in New South Wales. He brings a really extensive experience across corporate structuring, business law, employment law, contract law, and IP. So basically all the areas that matter when you're setting up and scaling a business. So he's worked day in, day out with startups, with founders, growing businesses, helping them navigate some of the most important strategic decisions they'll ever make. So with his background in law, finance strategy, Max definitely not only understands the legal side, but also the business side of these decisions. And then finally, before I hand over, what we'll actually be covering. So we will go through what is a business structure, what are the key structuring options, some tax and liability considerations, when and importantly, why to switch structures, final takeaways, and as I mentioned there, live Q&A at the end. So really, yeah, you're in expert hands today. Mash, I'll hand things over to you. The floor is yours.
Perfect. Thank you, Connor, for the great introduction. So, hello everyone. How are we all doing? Hope we're all doing well. So let's get into it. What is a business structure? So, a business structure is basically a legal framework for everything your business does. It shapes how you're taxed, who's liable if things go wrong, and how profits are handled. It also affects how clients, banks, and investors see you. This is one of the most important decisions you will make, your structure, because your structure is the foundation of how your business operates and grows. And why does it matter? Look, a structure isn't just paperwork. It defines how your business is taxed, how much risk you carry, and how easily you can grow. If you choose the wrong structure, it can cost you in exposure, it can cost you in tax, or it can cost you in credibility, and almost always it's usually a mixture of all three. The right structure protects your personal assets, helps manage profits, and supports your long-term vision. When choosing a business structure, there are a few key considerations that really matter, and they're the ones that I always start with when working with clients. Most businesses begin simple. They rarely stay that way. The structure you start with can quietly become a limitation as you grow, and you might not realize that it's a problem until it's too late. So, what's the first consideration? The first one is risk. This is about how much personal exposure you're comfortable with if something goes wrong. The wrong structure can leave your personal assets exposed in ways business owners don't expect. The next, taxation. Different structures are taxed very, very differently, and the way income flows to you, whether it's through salary, distributions, or retained profits, can have a significant long-term impact. Then there are costs. Some structures are cheap and simple to set up, but offer limited protection or flexibility. Others cost more, both upfront and on an ongoing basis. but they can support growth, investment, and risk management. And then beyond that, we look at control. Do you want to control, do you want to run everything yourself? Or are you planning to bring in partners, investors, or key decision makers? And then finally, we look at obligations. Are you comfortable managing directors' duties, reporting requirements, and compliance? These things are often overlooked, but become critical as your business scales. So, when I'm working with clients, I usually try to boil it down to three key questions. What level of risk are you comfortable with? How do you want your income taxed? And how much are you prepared to invest in setup and compliance? Every structure is a balancing act between these factors, and the right choice depends on where your business is now and where it's heading next. So, what are these key structures? Kind of given it away in the title. Obviously, there's a sole trader, there's a company, and there's a trust. But one thing that we didn't cover in the title, but I will cover today, is partnerships. It's somewhere in the middle of a sole trader and a company, but not really. It's not an ideal structure. I don't recommend it, but we'll cover it for the sake of simplicity. And remember, when you're picking up a structure, make sure that what works for your business might not work for you. Sole traders. So let's start with sole traders. A sole trader is exactly what it sounds like. You and the business are legally one and the same. There's no separate entity. You own it, you run it, you're personally responsible for everything. It's the simplest structure to set up. You just need an ABN, maybe register a business name, and you're in business. You can still hire employees and operate professionally, but legally, you are the business. The simplicity makes it perfect for freelancers, consultants, and anyone testing an idea without any major financial risk. But remember, simple doesn't always mean a suitable long-term solution. As your business grows, that lack of separation between you and the business can become a real problem. Now, let's break down the advantages and disadvantages of a sole trader structure. On the plus side, it's easy and it's inexpensive to set up. There are no formal legal agreements, just an ABN, and you're off. You've got full control over every decision, simple tax reporting through your personal income tax return, and fewer compliance requirements compared to companies or trusts. But here's where it gets serious. One of the major disadvantages is unlimited personal liability. If your sole trader business can't pay its debts, your personal assets are at risk. What that means is your home, your car, your savings, all of it is at risk if you can't pay your debts as a sole trader business. Another issue is it's also harder to raise capital because investors typically prefer companies and you can't issue shares of yourself. Remember that a sole trader is just a version of you. And finally, banks and commercial partners often see sole traders as less credible or inexperienced. And as your income grows, all profits are treated as personal income, which can push you into higher tax brackets. Sole traders work when you're starting small, but these disadvantages become real constraints as you scale. And this slide is critical as it shows why sole traders hit a ceiling. First, personal liability. As your business grows, so does your risk. More clients, bigger contracts, maybe employees, and all of it sits on you personally. And second, we have tax. You might be starting at a low marginal rate, but as profits increase, you're taxed at your personal rate, which can go as high as 47%. Company rates are much lower. And third, bringing in partners or investors becomes almost impossible. No shares to offer, no equity structure. It's just you. Many of my clients come to me realizing they've outgrown their sole trader status, and that's when restructuring becomes essential. Now let's look at an example of what you should structure as a sole trader. So we have Taylor. Taylor is starting a weekend business. She's making handmade candles. She doesn't expect much of an income from it. It's really just a hobby, and she definitely has no employees and is just testing out the idea here. For her, a sole trader is perfect. It's quick to set up and there's minimum compliance. She can register an ABN, register a business name, and see if this business works before scaling to anything else. So that sums up sole traders. Now we are going to talk about partnerships. A partnership is when two or more people run a business together and share the profits, losses, and responsibilities. Again, it's simple to set up just like a sole trader. You just need an ABN and you don't need a partnership agreement, but it's almost always recommended you have one. It's a natural step if you're co-founding with someone and that person is someone you trust. And the aim here is that you're pooling your skills, your capital, and your effort. But the biggest but in any partnership, you're also pooling your liability. When one partner signs, you're both going to be on the hook. That's why I always tell my clients, if you are going into a partnership, make sure you both trust each other and that you have a solid partnership agreement in place where you define your roles, define the splits, and your exit terms before you start working. So, what are the trade-offs with partnerships? On the plus side, it's simple and cheap to set up. You're combining skills, resources, and workload, and your tax is still personal. Each partner reports their share on their own personal income tax return. But the downside is real. You're personally liable for whatever your partner does, even if you didn't know about it. Disputes can derail the business if expectations are unclear. And if someone leaves, the partnership may dissolve or need major renegotiation. Plus, raising capital is harder than it is with a company. Partnerships work well for small, trust-based setups, but they require strong communication and documentation to avoid conflict down the line. Now let's look at an example of a partnership in action. Maya and Leo are forming an e-commerce site. They want to share profits and split costs. They don't want to set up a company just yet, but want some documentation in place aside from two friends working together. So a partnership is the best option for them. A partnership gives them a simple, low-cost setup, but comes with shared liability. Remember, when one partner signs, both are bound to it. A written partnership agreement is essential for them because it helps them manage their roles, split costs and profits, and determine exit terms. And now we're getting to companies, the main reason why most of us are here. And this is where things get serious. As most of you may know, a company is a separate legal entity. It has its own name, its own tax file number, and its own legal identity. What that means is that a company can own property, it can sign contracts, it can sue, and it can be sued, all in its own name and not yours as the owner or the director. Most businesses in Australia operate as a proprietary limited company, or better known as a PTY Ltd. The big advantage of a company is its limited liability. If a company goes under, your personal assets are generally protected. It's also the structure that investors expect. If you're planning to scale, hire staff, or raise capital, a company is usually the right move. So let's break down the pros and cons of a company. The big win is that limited liability. Your personal assets are protected if the business fails. You also get a flat tax rate of 25 to 30%, which can be lower than your personal income tax at the higher levels. Companies can also issue shares, making it easier to bring in investors or offer equity to employees. And it's a separate legal entity, which gives you long-term continuity. You can sell a company very easily through a share sale. If you were to pass it down to your family members or across generations, that's also possible. However, it's not without cost. With a company, there are setup fees, there are annual ASIC requirements, there's directors' duties to follow, and just generally more admin. Other admin can include filing its own tax returns, making sure you get the taxes right, complying with Div 7A requirements, and so on. However, for most companies and most founders, a company is the right structure to go ahead with. And this slide really shows why that is the case. A company is built for growth. Again, I keep harping on about this limited liability point, and that is crucial. Whenever you're in business, you really want to have a company which has its own legal entity and its own liability so that your personal assets are protected if something goes wrong. Obviously, as a director, you have additional duties as director's duties, and you can be held personally liable if you violate them, but those risks are far more contained than you would have been under a sole trader running your own business. Secondly, the tax rate. Companies are taxed at a 25% rate for base rate entities and at 30% for other entities. And you can retain profits inside the company to reinvest, which makes it much more tax effective than at the highest tax bracket for individuals. And third, equity. And I would argue the most important point for a company. You can issue shares of your company to founders, employees, or investors. If you want to bring in a co-founder with sweat equity, no problem. Want to raise capital, investors expect a company. It's a structure that will really help you grow and scale. And now onto an example of when a company is a good choice as a structure. Jasmine's building a data-driven buyer's agency. She's hiring software engineers with sweat equity and not salaries. And she also has two friends who want to invest cash for shares. Later, she plans to raise capital from institutional investors. For Jasmine, a company structure is essential. It enables equity splits, tracks ownership, and sets the foundation for future investors and growth. And finally, onto trusts. Everyone loves talking about trusts. Most people don't need a trust. So, now trust, and this is where it gets technical. A trust is a legal relationship. So mind you, this is different to a company which has its own legal personality. A trust does not. A trust is merely a legal relationship where a trustee holds and manages assets for the beneficiaries according to a trustee. Think of it like this. The trustee owns and controls everything, but they do so for the benefit of others. Trusts are common in family businesses, investment structures, and estate planning. The most common type being a discretionary trust, where the trustee decides how income is distributed each year. This gives flexibility for tax planning and asset protection. But trusts are not simple. They're complex, expensive, and come with compliance obligations. They're definitely not ideal for startups, but they are powerful in the right situations. What are the trade-offs with the trust? The advantages we all know about: asset protection, flexible income distribution, and tax planning. You can allocate income to beneficiaries in a way that minimizes the overall family tax burden. But the disadvantages are quite significant. The trustee carries legal responsibility and must act in the beneficiary's best interests. Setup costs are high. You may need to talk to a lawyer, most likely a tax accountant, and get yourself a trust deed, as well as an ABN and a TFN for that trust. And ongoing compliance costs do add up. You have to do annual resolutions, meticulous record keeping, and strict adherence to the trust deed. And then there's obviously your tax obligations like filing a tax return. If you don't follow these rules, distributions can be taxed at penalty rates. Trusts work brilliantly for asset-heavy or family businesses, but they are not for everyone. This slide captures the key advantages of a trust. So this is all about protection. Protection being more powerful than the simplicity of a structure. So firstly, it's asset separation. The trustee holds everything on behalf of the trust and not you personally. So if the business faces legal trouble, your family assets are generally protected. Second, we have flexible income distribution. You can allocate income to beneficiaries in different proportions each year, which creates real tax planning opportunities. This is especially useful for family businesses with multiple income earners. But here's the reality. Trusts are not setup friendly. As I mentioned before, they're expensive to set up, they're burdensome to maintain, and they require ongoing legal and accounting oversight. So yeah, keep that in mind when you are considering a trust. And now onto an example for trusts as a business structure. Amir runs a short-term rental business with his family and wants to protect their properties while managing income tax effectively. Instead of setting up a company, they use a discretionary trust to hold the assets. This means that the assets are protected because it's within the trust and it's held for the beneficiaries, held by the trustees, and it allows that rental income to be split across different family members to make sure you get the tax advantages, and it helps with succession planning as well. So by now, you know about the four key structures, at least at a high level. You know about sole traders, you know about partnerships, you know about companies, and you know about trusts. So, which one is the right one for you? Well, the simple answer is it depends. If you're just testing an idea with low risk, a sole trader might be fine. If you're building something with a co-founder, a partnership might just work. Just make sure that you guys trust each other. Companies are great if you're scaling, hiring, or raising funds, and trusts are great for asset-heavy setups or family-run businesses where you're looking for that tax flexibility. If you're not sure about what structure to go with, talk to your mentors, talk to your favorite AI tool, but most importantly, come and talk to us. We will support you with your goals and tell you what works for you. Now onto the tax and liability considerations. So, two of the biggest deal breakers around any structure: tax and liability. Sole traders and partnerships are taxed personally and carry full liability. Companies give you a 25% flat rate for base rate entities and a 30% tax rate for other entities, which is a much better win compared to your individual tax rates, which can be much higher. With trusts, they can be tax effective if you have parties to distribute to, and they give you immense asset protection that you don't get within other structures. However, within a trust, it gets very hard to raise any new investment. So think carefully about what you want to protect, how flexible you want to be with your profits and losses, and where you are going to go with your business when you are deciding. And now into costs and compliance. Companies and trusts cost more to set up and run, but you get what you pay for. Protection, flexibility, and a more credible presence. If you're just starting out, a sole trader setup makes sense, but if you're serious about growth and spending a bit on the right structure now, can really help save any future heartache and costs in the future. And now onto that point, when and why to switch structures. So you might have set up something that was cheap and now it's taking off and it's time for you to consider moving on. As a lawyer, I see this all the time. People stick with the original structure for too long. They might think, yes, maybe I'll move from a sole trader, but they don't take action. And then at this point, they're essentially earning way too much, taking bigger and bigger risks and trying to bring on investors, but they're currently as a sole trader. And that's when it's time to upgrade. From that point, you should consider moving on to a company so that you can protect your assets and really scale your business. And that company setup will really give you that option to scale. Switching is very common as your business grows. So please don't wait until something goes wrong to decide it's time to switch. So let's look at an example. Arjun starts prepping frozen meals at home and supplying a few local stores. Fast forward a few years, he's in Woolies, he's in 7-Eleven, and servers across the country. He owns his IP, which is his recipes. He employs staff, he has a chef and a few other people, and he runs a facility. He has a full-fledged factory where he manufactures these frozen meals. At this point, Arjun is woefully underprepared as a sole trader. He should have really moved into a company, at least two companies, one for operations and one to hold his brands, so that he can end up in a much safer environment for his business to really grow. And now we're going to jump up to what Arjun should really be doing. This is going to get a little bit more advanced. Fair warning, it's also a little bit complicated, but the idea here is to show you that it's possible that once your business really takes off, we can pick and choose the correct structure. We call it the gold standard structure, where we try to get the advantages of both companies and trusts together. So think of Arjun. We can go back to Arjun. He has a business. He's selling frozen meals. And the idea here is to split his business into two companies, an operating company and a holding company. And then the ownership will be through a trust. Let me get into this. Here's how it works. You've got the operating company, and that's known as the OpCo, and that's the business that does everything day to day. It hires staff, it signs contracts, it deals with customers. If something goes wrong, the risk sits here. Then you've got the holdco. That's your holding company. This owns all your valuable stuff, your brand, your IP, your trademarks, and shares in the OpCo. So if your OpCo gets into trouble, your valuable assets are protected in a separate company. So applying this to Arjun, his operating company is the one that deals with his contracts, purchase contracts, supplier contracts, and so on. And his holding company is what owns the IP of his recipes, owns the machinery, owns anything that's expensive and valuable. And the idea here is that with the operating company, you're quarantining your risk and your liability. So if, for example, he has a bad batch of food that he has made, then only that operating company can be sued because his buyer's contract is between the operating company and the buyer. So that means that that operating company doesn't own anything valuable. It doesn't have his IP, it doesn't have his heavy machinery. So when it gets sued, it's the opco that gets sued. Similarly, the holdco is just a shareholder in the opco, and the holdco has all the other assets that are valuable. And because the holdco is not contracting with any outside parties, the legal risk of the holdco getting sued is very low. And then above this opco holdco structure, which is also known as the dual company structure, we have a discretionary trust that owns the holdco. And that discretionary trust has a corporate trustee for governance and protection. This setup gives you the flexibility of a trust. For example, you can still make distributions to other family members, you can help with tax planning, and you can make succession planning a lot easier. The idea here of having a corporate trustee, which is another company to act as a trustee, is so that Arjun is separated from this company, from this trust and this entire structure. It's a corporate trustee that owns all of these assets. And this means that it's easier for that trustee to uphold the best interests of the beneficiaries. If Arjun were to be an individual trustee of this trust, it would be a little bit harder for him to demonstrate that he is upholding the best interests of the beneficiaries while also running his life day to day. So this is a very much a high level summary of the gold standard structure. This might not be the perfect structure for you. And to be honest, this structure isn't simple and there are real tax consequences of getting it wrong. If you are restructuring from a sole trader like Arjun or an existing company into this setup, you can trigger capital gains taxes, stamp duty, or other tax bills if you're not careful. And that's why when we are recommending this structure at Lawpath, we always rope in our accountants to work with you. We make sure that the transition is done properly so you don't get hit with a massive tax bill you weren't expecting. And alternatively, if there will be a huge tax bill, we will talk about this before any changes are made so that you can make an informed decision. On the point of this structure costs more to set up and maintain than each of the individual structures, naturally. And it's definitely not for everyone. However, if you are building something serious with real assets and a growth plan or multiple income stream, it's worth considering. Just make sure that you get proper advice before jumping in and you are informed as the owner to really understand the advantages and disadvantages before you go down any structuring path. So, our final takeaways. To wrap up, here are the key takeaways. Firstly, know your structure. Every structure has trade-offs. What you choose affects your tax, your personal liability, and your ability to grow. If it feels complex, that's usually a sign it matters and it's worth taking a closer look. Second, small decisions have big consequences. Choosing the wrong structure or sticking with one for too long can lead to compliance issues, missed tax benefits, or unnecessary personal risk. A common example is staying a sole trader far longer than it makes sense. Third, watch for growth triggers. Hiring staff, raising money, expanding, or moving into higher risk work are all signs your current setup may no longer be fit for purpose. And that's a moment that you should take to reassess. And finally, you don't need to be a lawyer, but you do know when to call one. When the stakes are high and the terms are unclear, or you're restructuring, every advice can save you a lot of time, cost, and stress. So the takeaway, your structure should evolve as your business does. Now I'll throw back to Connor.
Awesome. Thanks, Mash. So quickly, just to answer your question there, Jane Rose, yes, we will be sharing the slides that will be sent via email. And what I'm going to do now, I don't know if everyone can actually, yeah, should be able to click the links. If not, maybe just screenshot some of the resources there I've shared in the channel. This webinar will go on our YouTube channel. And the one there where it says reading your numbers, understanding financial reports for business owners. That was last week's webinar episode, which we did with Tim Quinn. So do feel free to check that out, especially as we tee up to batch lodgement in February, and of course it will fly by getting to June for the end of financial year. Cool. So in terms of how we can help, so just go to the next slide, please, Mash. So there's a few things with Lawpath. It's obviously that on-demand legal support, both with our accountants or lawyers, specifically for that legal support. We provide like custom drafting and review for businesses, either like through our subscription plans or through our marketplace. And I just kind of want to highlight there the 500 plus legal document templates. We nearly have a document for absolutely everything. One of the links I've also shared in there is how to create an employment agreement with Lawpath. It's about a 7-minute long video, and I'm really just sharing it, not so much about the employment agreement itself, but actually because it features a very concise demo of filling out any document. You could go get a very bog standard basic PDF version from the government's website, but where Lawpath's really helpful, aside from speaking to the lawyers when you do have questions on specific terms and clauses or provisions, wherever it may be, is the platform was built in with a lot of great software and AI tools, from a very specific ask function, review function, a drafting function, and it also has and will provide suggestions and insights based on your business as well. So it's a much more customizable tailored experience when you are filling out those really important legal documents for your business. So definitely check that out. And the final video that I've actually shared there is the how to register your company using Lawpath. So it's actually a quick video with yours truly, 3 minutes long, on what we actually do for people when they do want to come and set up a company with us for the first time, or even maybe the second time as well, if they did it elsewhere before. A few options here. So as I mentioned at the start, we do have a company registrations team, so you can always book a free call with them to ask them some preliminary questions. But there's another option there as well. It's definitely best suited and highly recommended to people with more complex structures, either for legal benefits or for tax benefits. And that would be actually signing up to our legal advice plan, it's that LAP, or even potentially, if you want to get the accountant's perspective, signing up to our accounting advice plan as well. And then typically what most people will do is actually book in their business structure call and discuss that legal structure of what they're trying to achieve and where it needs to best fit their needs. Or it's a case of, well, you do that initial consult with them, come back to the company registrations team, or you actually get the lawyer to incorporate the whole thing for you instead of the business structure. So a few options there. If you are looking to maybe do a dual company, ACN, maybe an ABN or even a trust. And then finally, what that looks like, if we just pop to the next slide, is that actually legal advice plan on this. So we're offering a 20% discount on the quarterly plan. Everything provides like 12 months access to the platform when you do sign up to a subscription. And it's very much as you see on the tin there. It's 30 minutes, unlimited legal consultations with lawyers. Slight caveat, it is one per day. On-demand live chat with lawyers. There's an unlimited on-call legal contract reviews where you do have questions on some of the terminology in your contracts. We'd like to highlight some limited employment HR consultations. It's a hot topic. And then if you are on that subscription, there is an additional discount on any fixed price quotes and all contract drafting. If anyone does have any questions like that, just feel free to email us, call in, book a time to either access that plan, or as I mentioned, if you're looking to set up a company for the first time, feel free to come and speak to us if you do need some support. So Mash, with the Q&A has built up, we've got about 16 questions in there, so I'll hand things back over to you.
Easy. Thanks, Connor. Yeah, I'll just jump through the questions. So 1204, Gary, with a family trust structure, how do we add new beneficiaries? So yeah, Gary, for that one, you need to basically do a deed of variation. So obviously we need to look at the trust deed first to see if it's possible. Most trust deeds are drafted so that we can make changes to the deed. And then if it is possible, then you need to do a deed of variation, which is essentially appended onto the trust itself. Typically, we suggest you get a lawyer to do it just so that they can draft it in line with what's on the trust deed itself. And then, yeah, within that, we can add new beneficiaries and so on. So, yeah, hope that answers your question, Gary. So, Michael, need to create a business in Australia with external franchises, like the opposite to the NAB Bank, which is based in USA with Australian franchisee, not looking for tax haven setup. And number two, what is a better structure, i.e., a company or trust for succession planning incorporating asset protection? Sorry, no, I missed that. Okay, that's not Michael. Michael, I think your one best, we have a consult. So if you reach out to Connor, we can try to help you better. It's just we just need a bit more context on that one before we can answer that one. Sorry about that, Michael. So yeah, Ravindra, what is the legal aspect of asset protection aspect between a company and family trust with corporate trustee? I mean, which one would be the better structure? So in a family trust, you can either have a corporate trustee, which is a company acting as a trustee, or you can have yourself as a trustee. You Ravindra the person, Mash the person, a person. We always say that a company is a better structure because you have the level of separation, because the role of the trustee is to act in the best interests of the trust, of the beneficiaries, which means that when you're the person acting as a trustee and you're also living your life, you have other businesses and so on, it's a bit hard to say that you're living your life and running your business in the best interests of the beneficiaries. So yeah, Our better structure for succession planning, we would say, is a trust with a corporate trustee in there. But again, with succession planning, there is more to it. So you should have a consult to see, whether a will is good, a testamentary trust is required. Yeah, there are a few other options worth looking into as well. So just wanted to know about partnerships using a unit trust, i.e. liability, limited liability partners. So look, unit trusts get quite complicated, specifically if we have partnerships as well as unit trusts in there. So best we have a one-on-one discussion on that one, Destiny. Can't really go into specifics here. Can a company be a corporate trustee for multiple trusts and SMSF as well? A company can be a trustee for multiple trusts. SMSFs are not in my scope, so I can't advise on SMSFs. I'm not sure about that one. However, keep that in mind that as the trustee, you have to act in the best interest of the beneficiaries. So again, you're going into the same risk as before of you as a person being the trustee. So, are there any practical differences between a discretionary trust versus a family trust as part of a business with operating company, holding company, and trust structure for the founding team? So, look, typically it's a discretionary family trust is the full name. If you're looking to make a family trust election with the ATO, then that has its own separate rules. I'm not an accountant. I don't know those rules exactly. I just know that that's the distinction. So, no, basically a discretionary trust and a family trust is one and the same. In your example, is the holdco paying 35 or 20 because it's not a base rate? Yeah, look, so the holdco, I don't know the exact rate on that one. Again, it's more the accountants that do the tax side of the story. My advice is on the holdco being that it's just a safer structure from an asset protection perspective. Um, if you sign a contract as a company under a PTY Ltd for a large scale event and you know you have to raise funds as you don't have the amount and then fail to fulfill the contract, can you be personally sued as a board member if you agree to the contract? Yeah, look, so that sounds like it's a violation of your director's duties because it should be in the best interests of the company, and you should really not be signing contracts when you know that your company can't deliver it. So there's more to this. Obviously, I'm sure there's more facts, so it's worth having a one-on-one consultation on this one, Marissa. Can a sole trader ABN be discontinued and then the same individual creates an entirely new sole trader ABN for a new and different business with the view to be scaled or um look, ABNs can be discontinued and then you can recreate your ABN again. But if you are planning on starting a new business, it's better to start as a whole new company straight away. Can you please confirm if it's possible to register multiple business names under a... Yes, it is. And if so, can the company... Oh, yep, that's also correct. Yeah, so you can have, you can have Roland Pty Ltd, and then you can run a laundromat, you can run a business, you can run a restaurant, whatever it is, under different trading names. You just have to make sure that you sign contracts as Roland Restaurants, sorry, as Roland Pty Ltd trading as Roland Restaurants. Yeah, that's possible. I've seen it happen with a lot of clients. However, remember that ultimately it's still the one company that has the one legal liability. So if your restaurant is not doing so well, your laundry might be in trouble and so on. How to protect my personal assets as a business owner, director, shareholder in a highly reliant business on bank loans. Look, that just depends, Niharika, if you're putting in a personal guarantee for any bank loans. If you're putting in a personal guarantee, then essentially you're personally liable. So often what I've seen clients do is they would have a discretionary trust set up for with a corporate trustee for their investments, and then they can have a personal guarantee on bank loans. They can own companies, be a director. So essentially, there's no assets in their own name because the corporate trustee of their investment trust owns all of their assets. And can you please explain in basic terms what needs to be assessed when the structure needs to be upgraded? Look, it just depends on those three key questions, your risk, your compliance costs, and also tax. So more often than not, everyone has to pay tax, and this upgradability comes in around looking at whether you can minimize your tax, which my accountant colleagues will help with, as well as the amount of risk you're taking on. So if you're working in high risk industries, so more recently, tobacconists being quite a high risk industry, it might be worthwhile moving on from a sole tradership. Brett, SMSFs. I don't personally look after SMSFs. I don't think as a firm we do. Connor, do you have any views on SMSFs? Do you know if we cover that?
No, we don't typically. It's out of scope here at Lawpath. But Tim Quinn, head of our tax and advisory, does have a contact if anyone needs some assistance there.
Cool. No worries. Thanks, Connor. Yeah, sorry about that, Brett. Yeah, I think that's the Q&As on this side. I feel like there's a few on the other chat as well, so I'm just going to go through them now. Let me just scroll up. Sharing the slides. Yeah, that's fine. If you sign a contract, oh, yep, cool. We talked about that. So thought the opco would be owned by a different trust as making more as a horizontal structure, not a vertical structure. Not necessarily. So usually the opco is owned by the holdco, and then the shares of the holdco is owned by the one trust of that family. And then if they own other businesses, so let's say Arjun now wants to diversify into laundromats, he would do another holdco opco structure with the washing machines and stuff being in the holdco, and then the contracting with the end consumer as the opco. So yeah, it'll be multiple opco holdcos feeding into the one trust. Can the holdco and corporate trustee exist in another jurisdiction? So, look, I'm not 100% sure about that one. I've only been practicing in Australia, and the deeds we tend to work with all have local holdcos and corporate trustees. But yeah, Brent, if you reach out to Connor, we might have other lawyers in our network that might be able to assist with that one. Since Holdco is a shareholder of OpCo, won't it expose it to risk as it holds IP? No, so the Holdco is the shareholder of the OpCo. That's fine. It just owns shares of the OpCo. So a shareholder of any company is only liable up to the share value of that company that they have bought the shares for. That's the whole magic of owning a company. So let's say I own shares in Connor's company, and then that company doesn't do too well, and I've given him $100,000 to start up, this company. That's all I'm going to be liable for, that $100,000. I won't be liable any further for any other issues that Connor might have done. He might have taken my money and gone to the Bahamas. Well, it doesn't mean, oh, he's not paying his taxes. Nothing will happen to me, except I'll just be 100 grand poorer. And then what else is there? Thanks. YouTube. The gold standard structure is great in theory. However, in our experience, when it comes to applying for finance with major lenders for the asset purchases, properties, for example, properties, they're not comfortable with it and often decline to accept the application. What is your feedback? Yeah, look, I am not in the lending industry. So yeah, look, if that's the case in lending, then I guess, it is what it is. I would say that the structure is great from a liability perspective, but again, it's going back to the initial question of the risk profile of the customer. If they really need that lending and they can't get lending with the gold standard structure, then they have to take on more risk to get that lending. And what is best for liability coverage that doesn't automatically trigger the 30% company tax when starting out? Currently a sole trader. So to be honest, I'm not really understanding the second half of that question, but if you're starting off as a sole trader and you're a bit weary about going down the company path and you still want to limit your liability, definitely have contracts in place that are going to limit your liability. So you can obviously have limitation of liability clauses and so on in the contracts themselves. However, keep in mind that if, for example, those contracts are not executed properly or there's some issues with it, and it eventually ends up being your fault, it goes to court, goes to some tribunal, then you are personally liable. That's my 2 cents on this one. So yeah, I think that's all, guys. Yeah, thank you all for attending and thank you all for your insightful questions. I'll throw it back to Connor to wrap it up.
Well, thanks, Matt. And yeah, just kind of throw his advice a bit in there just for some of the more complex questions is generally always better just to sit down for 20, 30 minutes and actually hash it out and kind of get into the weeds of what's going on in your business situation. We do provide actually a free call, both with the accountants or with the lawyer for 20 minutes. So if anyone, for whatever reason, doesn't even have to be about business structure today, thinks they might benefit from that. Do get in touch with us, or if you want to speed up that process, just type yes in the chat, and I'll send out an email and a link to help you. Um, in line with that as well, so just kind of reading some of the topics people would like to see more of in Accounting and legal, in all humility, I'm not sure if that's referring to a combination of having a lawyer and accountant on the same topic, or if there's anything you guys specifically looking for, feel free to comment that in the chat as well, and I can share that feedback on to our team. But rule of thumb is anything actually listed in there. If you scroll back far enough on our YouTube channel, you'll either find a webinar episode on it or a shorter 3 to 6 minute video, bite-sized version as well. There's loads. We have an employment, different business structures, the legal documents. We have done a legal Q&A, but I don't think it's actually on our platform. Same as some of the company registration webinars we've done as well. But they are very popular, so I'm sure we'll do another one. But on that, if anyone is still kind of scratching their head or wants to just have a conversation, it's much better to have a back and forth than just, I think, reading slides and listening to us talk one way. Do feel free to get in touch. You can also speak to anyone on our company registration team. While they're not lawyers and accountants, they can certainly help put to rest or put to bed any concerns you might have or point you in the right direction. So we'll leave the webinar up just for a couple more minutes. If anyone does want to type yes in for either that free call with our lawyers and accountants or wants to put any suggestions in for future webinar content.